morning and welcome to the show, Naren.
Hi.
So let me start by asking you, it seems that the markets have been shaken and stirred by the recent developments. Have they finally put the negative news behind, or there's more nervousness that would come into play?
From 2008 to 2021 November, the Fed and other central banks in the world had one objective, which was basically take care of the markets. And after November 2021, they have slowly moved to a different objective, slay inflation. So if your objective is going to be slay inflation and not take care of the markets, you're going to have volatile markets. So till the day the Fed changes its mind and say we are again going to take care of markets and growth and employment, we are going to have volatile markets. And volatile markets does not mean that markets have to go down one way. They can go up and they can go down, but you'll have volatile markets.
So how does one navigate this volatile phase?
The first and easy way is to do it through asset allocation. And I believe that we think that as long as you follow an asset allocation framework and look at categories like balanced advantage and all the hybrid kind of categories and an asset allocation framework and follow SIPs and STPs, you're actually through with this kind of framework, because this kind of a framework is well suited for the volatility phase which exists at this point of time. Another very key ingredient which actually was very irrelevant in 2021 was the role of debt mutual funds like the floating interest category in this kind of a phase. And we believe that that is something which also becomes core in this kind of a category. And so I think with this kind of a framework, I believe that you don't have to worry about what the Fed is doing or is going to do in the near term. But the long-term outlook remains good. And people will make money out of this kind of a strategy and benefiting out of volatility. So you can benefit out of volatility by and increasing interest rates by only through things, by following an asset allocation framework and by looking at product categories like floating interest.
To what extent are the markets and investors discounting the possibility of the Reserve Bank of India being very aggressive with the rate hikes in the next 3 to 6 months?
At ICICI Prudential, we are much more comfortable with the idea that Reserve Bank also will have to increase rates significantly. The latest MPC minutes also signify that. And with that viewpoint, we have been believers in the floating interest category. But whether the markets themselves believe in it or not is a bit more difficult to understand. So I would say that we have been very clearly not surprised by what happened a few weeks back in terms of a rate hike. And we would not be surprised by further rate hikes in both June and August meetings. We looked at the global developments, we looked at the India inflation numbers, we looked at the way India forex reserves were falling and came to this conclusion. And frankly, it was in tune with our frameworks that we have in our fixed income research process. And that's why I think we were not disturbed by the events. And I think it's interesting again there at this point of time.
So a lot of support has been lent to the markets by the domestic institutions and the retail investors at a time when the foreign investors have sold as if there was no tomorrow. When do you think that some sense of caution or some sense of fatigue will start to creep in as regards investing in equities from the mutual fund side as well as the retail side?
There's a worry I have that whether the retail investor will continue to show the same level of interest if markets continue to go down. And frankly, it's something which has been a very interesting development over the last 6 months. And I hope they continue to show the same enthusiasm if markets continue to fall. Because if they were bullish at 17,000 and 18,000, they should continue to remain bullish as markets fall. And that is what we are hoping for. And does it make logical sense that as markets fall, that they should continue to remain invested or invest more? The answer is yes. And we are hoping that they will do it. But that is what that is one of the most interesting things again, which we're going to see, because no one would have believed that foreign investors will sell 20 to 30 billion dollars of foreign equity, and that money will get completely absorbed by local investors without a big fall. Having said that, we are big believers that large cap has more margin of safety compared to mid and small caps, because bulk of the selling by the foreign institutional investors has happened in large caps. And consequently, we are big believers that there is a bigger scope for investment at this point of time.
But then at the 17, 18,000 level, Naren, a lot of investors, retail investors and mutual funds were kind of ignorant about what's going to happen, and probably had a, if I can put it this way, a laid back attitude in terms of what the US Fed also may do. The sense of caution and worry has only now crept in, and that is why you see the kind of selling we are seeing now. Don't you think it all makes for a very scary overall situation for the markets?
I don't know, because end of the day, when the market touched 60,000, we even prepared a note and sent to the mutual fund distributor community explaining that the markets are no longer cheap. And we did communicate that the models that we use in the balanced advantage fund or in our asset allocation models did show a much lower allocation to equity than before. So I do believe that we did communicate all this through whatever the fact sheet and various other ways. And in fact, markets are more attractively valued today than they were 3 months back or 6 months back. I hope investors recognize that if the markets correct from here, markets are going to be more attractive than they were 3 months back or 6 months back. And that's something I hope investors recognize and put it into their investment framework. And that is what we would want investors to do, and we would want investors to continue and start SIPs at this point of time.
Given the way markets have actually done over the past few weeks and months, do you think that the structural bull run in Indian equities and global equities also, for that matter, have been broken, and or do you think that this is just a mild flash correction phase like we saw in 2020, and the recovery was equally swift and fast?
See, the 2020 was a very, very fast V-shaped rally, but nothing changes the structural long-term positive outlook on India. Having said that, you're not going to see the kind of rally that we saw in 2020 in the near term, because that was driven by huge Reserve Bank support from every Reserve Bank in the world. So if today the US Fed were to again come and say, I'm going to do quantitative easing on a large scale, then yes, you're going to see that rally, but I doubt whether they will do it at this point of time. So we are not going to see big, large rallies in the near term. But having said that, I think India is one of the most structural long-term stories for global investors, and that too with the way what has happened in some of the other key emerging markets. India has become more attractive for the long term than some of the other emerging markets.
So a lot of heavy lifting was to be done by the growth in corporate earnings before this slide began. Do you think that this is another setback waiting to happen for the markets as India copes with the rising input costs and wage pressures?
I don't think corporate earnings are a problem. In fact, one of the lessons that we all learned at ICICI Prudential is that there is a deflationary market and an inflationary market. In an inflationary market like 2002 to 2008 or the period after 2020, corporate earnings is never a problem. It is only in like a deflationary market like 2013 to 2020 where earnings becomes a problem. I don't think corporate earnings is a problem even now, and you would see that many of the corporates are actually delivering good earnings growth at this point of time. when inflation happens, it is someone's output, and that person's output price goes up, that person's earnings goes up, that company's earnings goes up. Second is the financial system is in much better shape than 2017-18. At that point of time, so many financial services intermediaries had to provide for huge non-performing loans. Today, you look at it, the non-performing loans in the corporate sector have all been provided for, and there are hardly any non-performing loans. And overall, the financial system is not vulnerable as it was in 2018. And the only challenge at this point of time has been credit growth has been low, not that there have been too much non-performing loans. So I think we are in a much better structural situation as far as earnings is concerned. We have only had challenges on valuation rather than earnings at this point.
In terms of sectors, where do you think the leadership will come from if the markets were to take a U-turn for the positive?
See, we clearly always believe that leadership gets taken place in sectors which have done not too well. So if you look at which are the sectors which have performed badly over the last 5 years, clearly banks head that list. Auto heads also is a second sector. So we clearly believe that banks, auto, and to an extent sectors connected to the capex cycle and some of the PSUs. These are all areas which have not done too well in the last decade. And so these are the kind of sectors which actually have the potential to actually start delivering from here on, because they were the dogs of the last decade. And we are believers that dogs of the last decade have better potential to actually deliver over the next decade. And that is the way we see things at ICICI Prudential.
Thank you, Naren, for your time today. We hope to see you soon.
Thank you. Thank you very much.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.